move into our first move. When we think about our portfolios, it's important to understand the risk side of things. And today, we clearly see a risk aversion to markets. And that means from an equity perspective, we are dialing down our equity weight and taking it to an underweight positioning. A -1 is what we're at, which means that we're anywhere between -1 to -2.5 underweight on equities. This really is the fact that we expect the consumer to continue to decline, and that means that spending will decline, consumer profits will decline, and that will mean that stock prices need to go lower from here. The second part of that is we're also underweight to fixed income. Now, yields are currently in that high 2% range, so not as high as we saw earlier at 3.5%, and we know we're still going to see the Fed continue to push rates higher up against so are other central banks. That means to us that there's still some negativity there on the bond market, and as such, we're underweight bonds by -1, which means anywhere between -1 and 2.5% underweight bonds. Where we are a bit more optimistic is on cash, and we're really going to hold cash here to reflect the fact that we don't see opportunities quite yet in the equity markets, and there's still downturn in the bond market, but we want to have that liquidity to jump into the markets should we see, further declines and opportunities persisting at that stage. So we're a +2 on cash, which means we're anywhere between 2.5% to 5% overweight cash, and that really is quite a bullish signal on the cash side of things.